Good evening, everyone. Yesterday, we launched the much-awaited ISC Bridgespan report on debt in impact finance, giving credit where it's due. But today, we want to move beyond lending models and look at some of the non-credit models that hold promise in India. Welcome to the session, Financial Access Going Beyond Lending Models. Macro and government infrastructure has provided tailwinds for further digitization of financial services, enabling greater access and inclusion. In today's discussion, we could probably look at what are the verticals that have emerged and what have been the levers that have propelled growth in these verticals. Other than credit, we have new verticals emerging like payments, online and offline, savings, wealth tech, insurtech, neobanks, digital enablers. Have any segments, companies grown to scale, and does it drive inclusion? I know it's a tall order, but we have an illustrious panel here to discuss and debate about this. Welcome to the session, dear panelists. Amol Varange is going to moderate this discussion for us today. He is Director Investments, Omidyar Network India, and is responsible for sourcing, evaluating, and managing investments in financial inclusion. But before that, Priyanka Chopra is going to set the context with a quick presentation. Priyanka is the Chief Operating Officer and Managing Partner, Seed Investing at CIIE.co and a Venture Partner at Bharat Innovation Fund. Over to you, Priyanka.
So good evening, everyone, and welcome to the discussion on financial access beyond lending. I am Priyanka Chopra from CIIE.co, built by IIM Ahmedabad. CIIE.co is the innovation continuum that spreads across research, incubation, acceleration, and funding for innovative early-stage enterprises. I'll take about 10 to 12 minutes of your time to set some brief context in today's conversations. Ranjana, can you please just...
Sure. Just give me half a second, yeah. Sorry.
Thank you.
Sure.
So we all know that India has emerged as a leading global innovation hub for fintech. Growth is being driven primarily by two key enablers. The first being India's well-developed public digital infrastructure, foundations of which were laid with Aadhaar, which is the unique digital identity for all residents of the country, and India's tech APIs that enable presence-less, paperless, cashless, and consent-based delivery of services. Fintechs have leveraged India Stack's open APIs that help authenticate identity, complete KYC, make payments digitally, sign documents digitally, and share data with consent to build solutions for various use cases. And the second key driver has been the pro-innovation regulatory and policy regime in the country, the cornerstone of which has been the Jan Dhan Yojana, which aims to ensure that every Indian has a bank account. Other initiatives such as launching regulatory sandboxes for fintechs, allowing for remote customer lifecycle management, emphasis on data protection and privacy have all supported the growth of fintechs in the country. Anjana, thank you. Yeah. So digital lending seems to have come of age in the country. There have been over 300 startups across categories such as secured and unsecured consumer lending, SME financing through digital platforms, aggregators that serve as marketplaces to help borrowers compare and find more suitable lenders, P2P lending platforms, and others such as education loans, payday loans, point of sale financing, etc. That said, with an estimated $500 billion credit gap for consumer and SME financing in the country, and fintechs which hold maybe about a 0.5% share of the personal loan market, there is still a very long way to go. Several recent initiatives such as the account aggregator frameworks and OKEN hold a lot of promise. I'm sure you would have learned about these initiatives in the previous sessions. While the digital lending space in India is growing and poised for some very exciting times ahead, several other sectors have emerged on the back of a very proactive regulatory environment and growing digitization across the board. The largest of these categories is digital payments, which has been in some sense the flag bearer of the Indian fintech space. These solutions include both consumer and merchant payments using innovations such as UPI, e-wallets, biometric-based payments, sound wave-based payment technologies, etc. In fact, the sector is currently witnessing its second growth spurt after demonetization. And some notable examples here include companies like PhonePe, Paytm, Razorpay, etc. The second category is neobanks, which are basically digital-only mobile-first banking for both consumer and small business segments. And there are two such models that exist in the country. First is non-licensed over-the-top neobanks. These are standalone digital platforms that do not have their own banking licenses, but offer products in partnership with FIs, banks, and other fintech firms, and usually at a cost which is quite lower than that of traditional banks. The second model here is digital only brands of licensed incumbents. These are standalone digital only brands created by traditional incumbent players, for example, SBI's Yono, Kotak's 811, etc. Coming to wealth tech, this segment consists of investments in wealth management platforms and analytics. Wealth managers in India are now increasingly leveraging technology to offer low cost investment advisory to mass segments. And some use cases here include robo advisory, goal based mutual fund investments, discount broking, etc. And notable companies in this space are Zerodha, Scriptbox, Grow, Kaleidofin, etc. Insurtechs are companies that are either selling insurance digitally or providing software and analytics to insurers. And several models again have emerged, such as insurance web aggregator platforms, digital insurers, insurance infrastructure APIs, which provide insurance as a service, embedded insurance, sachet insurance, underwriting and risk management to make better risk coverage decisions, etc. Again, examples here are companies like Digit, Acco, Toffee, Discovery, and these span, all the subsectors from digital first insurers to aggregators and insurance API providers. Coming to fintech infra companies, these are companies that are building APIs that enable any software company to offer financial services directly to their end customers. They basically build pipes that connect fintechs with incumbents and drive financial services to underserved communities, helping reduce the cost of distribution, cost of accessing customers. Some notable examples that have emerged recently are companies like Setu, Perfios, Verify Digital, etc. And finally, if going beyond core financial services, there are emerging themes at the intersection of financial services with other industries. The most prominent amongst them are agri-fins that offer financial services across the entire agri-value chain, offering solutions such as input financing, equipment financing, invoice financing, crop insurance, etc. And we will be discussing more in the discussion following this presentation. So India has now emerged as the second largest fintech hub after the United States with over 2,000 plus startups. While the first wave of fintechs in India were primarily focused on payments, they are now present across a broad range of segments. Payments still constitute the largest share of fintech startups in India, but closely followed by lending, wealth tech, insurtech, and others. Fintech has attracted significant capital from investors. In fact, it emerged as the most preferred sector for investments last year. And cumulatively, the sector has raised about $10 billion till date across about 600 odd deals. Payments and lending has garnered the largest share historically, but of late, insurtech has emerged as an attractive destination for investments. And of the roughly about $3 billion that the sector had received in 2019, about 10%, which is about 300 million, went to inclusive fintechs. And by inclusive fintechs, I mean companies that are specifically targeting underserved low-income communities and solving for their challenges. So while fintechs have pioneered several innovations, have redefined financial services in the country, enhanced access, penetration across customer segments, I wanted to just highlight some representative fintechs that are specifically looking to address challenges of low-income, underserved segments across payments, remittances, neobanking, insurance, savings, agri-fin, etc. Their distribution, maturity, the amount of funding raised largely mirrors the overall trend in the fintech ecosystem. Insurance and wealth tech for these categories, these customer segments have recently started to see greater action. But I think the key thing to note here is that now we have examples of players across all customer segments and all product domains in the fintech industry. So I'd like to end with a quick overview of the Bharat Inclusion Initiative. Basically, this is a platform that we have set up to catalyze technology-enabled solutions that boost financial inclusion for the underserved. And I also wanted to take the opportunity to highlight some novel experiments that we have been seeding and co-creating, which go beyond conventional lending. We chose to take a full stack ecosystem approach when setting up this initiative, starting from research to understand the gaps and aspirations of the low income communities, surface new use cases using research, then incubate and accelerate startups so that we can handhold them and de-risk their journeys via offering them grant support, and finally seed funding to provide patient capital to promising solutions. And we work again across all of these product categories via our acceleration and seed funding efforts, but specifically wanting to highlight, the four experiments which are potentially very disruptive at early stages, but go beyond conventional lending. So on the capital side, we have two experiments. The first one is what we call participative finance. Cognizant of the fact that capital is a large unmet need for small micro entrepreneurs and that credit may not always be the right instrument as it burdens them with fixed repayments regardless of the state of their business, we are now exploring a new instrument, which is a risk reward sharing micro equity like instrument. There are certain challenges here we need to solve for structural impediments, including the informal nature of these businesses, lack of agency for the investor, he has no visibility into growth, bookkeeping, etc. But trying to put this experiment together. The second experiment on the capital side is P2P micro guarantees. Given the current credit environment, we are in the initial stages of exploring a large-scale digital platform for enabling P2P micro guarantees that can leverage small portions of middle-class savings to unlock commercial capital for underserved micro entrepreneurs. And outside of capital, there are two more experiments, one in the payment space and one in the insurance space. Recently, we ran a challenge to identify and support digital payment solutions for feature phone users. Over half of low-income users in the country use feature phones and are unfortunately left outside the ambit of formal finance because they're not able to access digital payments. Three companies won the challenge and are currently being supported by NPCI to bring their solutions to market. We are also supporting creation of a digital-first platform for mutual health risk sharing, basically solving for problems like product relevance, trust, transparency, accountability, etc., which is associated with traditional health insurance products. We would welcome any feedback, any comments, on these experiments. So this concludes my context setting. Amol, over to you.
Sure. Thanks, Atan, Priyanka. This was pretty informative. Let me quickly introduce Omidyar Network India and the work we do, and then we dive straight into the panel discussion here. So Omidyar Network India is an impact investment firm with a mission to invest in bold entrepreneurs who help create a meaningful life for every Indian. We have a dual checkbook approach where our work spans from supporting research and making grant investments from the grant book to doing venture capital equity investments from the equity book. We invest across 6 different areas: digital identity, governance and citizenship engagement, property rights, education, emerging tech, and financial inclusion. We have invested close to $300 million so far across 102 organizations. The split towards for-profit venture capital equity investing is around 70% of the amount. I look at investments in the financial inclusion space here in India. So moving on, I think we have a stellar panel here to talk about the business models beyond lending. It's a privilege to introduce this panel. Let me do a brief round of introductions and then we can dive into the discussion. So we have with us Aditya Mohan, who is a senior investment officer for Asia region at Triados Investment Management. He focuses on equity and debt investments in FI and the agri space. We have Mahesh Yagnaraman, who is the country director at Acumen. Again, Acumen Fund is a well-known organization in India focusing on equity investments in early stage companies with a specific focus on businesses which provide products and services to the poor. We have Mona Kachpa, who is a partner at Unitas Capital Growth Equity Fund. Mona has been instrumental in conceptualizing of the Impact Investment Council and also served on the executive board, on the inaugural executive board there. We have Rohan Kumar, who is the co-founder and CEO of Toffee. Toffee is a young company focusing on micro insurance for the millennials. We have Saras Agarwal, who is a principal at Bharat Inclusion Seed Fund. Saras leads investments in spaces such as finance, health tech, agriculture, education, and livelihood. We have Shashank from Gay Ghost Ventures. We have Sri Krishna Ramamurthy, again from Unitas Ventures, again a very well-known impact fund. Last but not the least, we have Tom Keller, who is the Director of Equity Investments at Credit, a global social investor with assets in excess of $1 billion. So thank you, gentlemen, for taking time out and being with us on this panel. So moving on, I think Priyanka highlighted quite a few segments in her presentation which go beyond lending. It would make sense to pick up a few segments and discuss these in detail. So let's talk a bit about and dwell deeper into segments like insurance or insurtech, savings, neobanks or challenger banks, and lastly, how impact is driven across all these segments through various business models. Okay. So let's start with insurance. And let us start with Rohan, who is the entrepreneur amongst us and very much on the ground. Rohan, it will be good to understand how has COVID changed the consumer behavior in this sector? What trends have emerged? What trends seem permanent as opposed to this just being driven by the current scenario? Would love to hear your thoughts on that.
Sure, thanks. Thank you, Amol, and lovely to be here with a great set of panelists. And I'm definitely the black sheep out of this entire panel in the forefront. So look, I think, if we sort of take a pre-COVID and a post-COVID sort of view, insurance typically for the longest time across the world has been a push product. And I think what's amplified that is in the section or the demographic which has been underserved or underpenetrated through insurance. It's typically been the lack of liquidity, which has been the biggest hurdle for most consumers to adopt insurance. So lack of liquidity followed by the lack of education followed by lack of access, and lack of access followed by the lack of contextualization of products. So I look at it from that particular order. And sort of what COVID has highlighted or done is suddenly taken a product which was predominantly a push product, driven on fear, and made that fear large, loud, and clear to everyone. So not only have the liquidity uncertainty hasn't gone away. So that same demographic is still uncertain, probably more so than he was prior to COVID, about his livelihood, his income. But now what he's staring at is a situation where mortality risks are a lot more larger than life. So he sees mortality, he thinks about hospitalization, and he's also seeing the rapid increase in sort of the kind of costs. So what's happening is you've got a demographic which is very quickly put in a position of reassessing their entire protection layer at the very least, and saying, if I'm going to be earning 20,000 rupees, do I have enough kept away for going to a hospital and paying for costs if that need sort of had to come through? He can't stay back at home like most of us, because they have to make sure that the momentum of income continues in the same format. So they're putting themselves out at risk. So what we've seen change as operators at the ground level is that there is a certain pool that has been created in terms of asking and finding out what are my options, what kind of products are available, what are some of the government schemes that are available if I can't afford. So I think there is this, I wouldn't say necessarily a push is completely turned into a 180 of a pull, but there is this need of discovery that has come about in that space. And what we've been able to do is use that sort of need for discovery to educate a consumer about what are his options. And that creates an interesting point for most insurance businesses or manufacturers or new startups like us to go out and contextualize and saying, there is an opportunity today where In the past, you had to go and educate this consumer about the need to have insurance. Today, you don't have to do that. You can skip that step. You can almost sort of go to him and say, hey, by the way, we know this fear is real. You have a requirement for a product. Can we now focus on the contextualization of the product, the efficiency of the process, and the onboarding? So our focus has suddenly shifted from necessarily going out there and telling customers why they need insurance to more about, look, you need insurance and this is how you should buy into insurance and these are the kind of products. So I think some of these changes, and without me sort of rambling on and on, are going to be, at least for the short to middle term, they're going to stay. There are very few sort of incidents that happen over centuries which see a behavioral change. And we can see that behavior change happening through. It will still take time. It will take that continuous reinforcement of the fact that a protection layer is extremely important for financial stability. And that's what we sort of seeing from the ground level up. So I'll take a pause there.
Got it. That's interesting, Rohan. Let's get an investor's perspective on this as well. And I would like to bring in Saras. Saras, from an investor's perspective, what are the changes you're seeing in business models on the ground across your portfolio and the other companies you track? What are the challenges you still see for businesses in this sector?
Sure. So thanks, Amol, and pleasure to be participating here. So I'm part of Bharat Inclusion Seed Fund, and we do investments in businesses which either leverage technology or build technologies to drive inclusion. So I think, Amol, if we see, the impact of COVID, I think one thing is very clear, wherein, businesses which had a larger kind of field operations, of course, there is a great impact, negative impact, I would say, because we did see, operations got stalled for some time while it is coming back, but for sure there was a, impact that we were seeing across all different metrics in all the businesses. On the other hand, of course, digital transformation suddenly kicked off, and some of the companies that we closely work with, which are involved in digital transformation or which create API layers or provide technologies like that. Of course, it's we see that as an inflection point, because whatever digital transformation happened in last 4 years, maybe this 6 months, these companies were able to actually onboard a lot of, large asset owners, be it banks or, be it large insurance companies and things like that. So definitely that's a very visible change that we see. If I talk about insurance per se, and particularly, given we are also invested in, a company called Discovery, which is, which has taken a different approach towards distribution of insurance by creating APIs. Which would then be integrated with different sort of online/offline alternate distributors. Of course, I echoes Rohan's comments there that the adoption of insurance products definitely has increased. People are realizing the need for, I don't know whether it's gonna sustain or not, but definitely there is that inflection that we see, a positive tailwind that we see as far as insurance is concerned.
Got it, Saras. And any business model challenges that you see will still remain in this space?
Sure. So business model challenges, of course. So for example, place where there is a large field force. So whether it's around distribution or around collections, the challenge remains in terms of, who would go and collect, how would he or she go and collect. You had people on ground who maybe have gone back to their hometowns. So whether you're talking about a DSA or a agent or say any of your reselling agents, those folks are not there. So definitely the way we are seeing in a lot of those cases, the businesses are taking a view that they need to figure out alternate mechanism of distribution, whether they sort of take an online approach towards distribution, or whether they find alternate mechanism of onboarding different partners, which could be, say, converting their existing customers as their distributors, or finding some sort of completely newer category of distributors. So from that standpoint, definitely we see business wise there is that impact of wherever your operations, you had a large degree of dependence on operations. Those are definitely changing, and we are seeing that change across our portfolio and a lot of startups that we speak with.
Got it. Thanks, Alex. This was very helpful. Let's move on to another sector, which is savings or wealth tech. And let me bring in Mona here. Mona, how has COVID changed consumer savings behavior? Again, what trends do you see here? How many of these seem permanent? What's happening on the ground?
Hi, Amol. Hello, everyone. Amol, I think COVID. There are two things I'd like to highlight. One is based on data, and the other is based on just the experience of interacting with the players in the space. What the data shows us, this is the RBI data as of the June quarter. September quarter, I don't think is out as of yet. But interestingly, the pace of growth in savings, so the savings rate defined as year-on-year growth of savings across banks, all format of banks, has outpaced the growth of credit for the last straight 3 quarters in a row. So this actually means even the quarter pre-COVID. The shift kind of started in the September quarter, where it was 10% growth in savings, 9% growth in credit, and it was sort of the reverse earlier. And there was, I think, for the previous 4 quarters, there was a clear 3 to 4 percentage points difference in the credit growth versus savings growth. So credit was always on the higher side, and then we started to see a shift in the September quarter. I think this obviously is to do with various factors such as how much people are investing in businesses, etc., versus savings, and where else are they saving. But this might have not had such a big shift as we saw in the June quarter, and I'm sure September is going to be similar, as we've seen, which is almost like a 5 percentage point difference. So the year-on-year savings growth was 11.5% versus credit growth of 6.5%, and that clearly is attributable to COVID. Also, I think Amol, you obviously know this very well. There was a survey that we did, like a study that we did for Flourish, we as in Unitas Capital in partnership with Flourish, which shows during COVID times, savings was sort of the topmost financial goal of the people that were surveyed in the lower income segment. And even if you look at the second, third, fourth financial goal, it somewhere relates to saving or conserving cash and so on. So all of that is reflected in what we are seeing in the banking balance sheets, the amount of savings that has flown in. Also, interestingly, this is true for all categories of banks and across different geographies. So whatever cut you take, urban, semi-urban, rural, metropolitan, all these cuts are available, and it's the same. There are, of course, some differences, like the amount of savings flowing into certain geographies is more than the others. But I think the larger point to be made here is that. And then when we look at also more anecdotally on this point, besides the data, since I have I have been tracking and I've been associated with the small finance bank sector. What we've seen is, and this is very intuitive and correlates with the whole phase of lockdown and unlock that we went through between broadly April to June quarter and then July to September quarter. The balances went up in saving. The average balance of small savers, so I'm not talking about all types of deposits, all types of customer segments. I'm talking about small savers. The average balances went up in the April to June quarter, and they started to deplete quite a bit in the July to August quarter, when it could be correlated to the fact that people were their incomes were impacted, or business activity was impacted, and they were living off more of their savings. And we are seeing it go up in the September numbers. So let's see what the RBI data shows overall, what the savings rate has been. But I believe, based again on surveys, anecdotal sort of understanding from institutions and the data, some of this is likely to stay, which is the savings rate will be high for the medium term. The second aspect of the shift because of COVID, and this is also brought out by my previous panelists, Saras and Rohan, is about digital onboarding on savings. That has obviously got a big boost. So for the last several years, that banks that have focused on the excluded segments have tried to do this, but the kind of boost it has got now, which is through the mobile apps, and is much more that we've seen in the last 6 months than we've seen in the previous 3 years, and again, for reasons that we know very well. But what that has required the banks and the new banks to do is to bring about a greater digital literacy. And in some cases, interestingly, the financial literacy kind of programs have been pivoted to focus more on digital inclusion. And just and I was very encouraged to hear what Priyanka mentioned about finding solutions for the feature phone set of customers, because that will bring about a bigger boost to this. But the short point of this is digital onboarding has got a big boost. The middleware partners, all that again Priyanka alluded to, e-sign and document verifications, etc. All of that has, of course, eKYC has got into making this a reality. And again, the numbers that you see of digital savings, sort of payments into savings accounts or transfers using mobile apps, etc., just seeing a big jump month on month and not just quarter on quarter. So these are the two broad sort of changes that we have seen. And on the second point, I would say what seems very permanent to your second question, sort of the corollary question, is the sort of collaboration between incumbents, banks, and the digital players and the digital service providers, and whether it's new banks or the fintech layer, however you want to describe it. That shift seems very permanent to me. And if I may sort of stick my neck out and say one more thing on this, which is I feel that the smaller or the newer players on the banking side will probably move pretty fast, and much faster than what we've seen in the past. And so possibly even faster than some of the larger ones.
Sure. Thanks, Mona, for that insight. Let me bring Sri Krishna here, who has invested across savings models and businesses here in India. Again, Sri Krishna, question to you is: what do you see on the ground? What change is happening? How are businesses adapting to this change that's happening on the ground?
Cool. Thanks, Amol. Great to be here, and hat tip to IIC and the Prabhav team for putting all this together. We've sort of looked at the entire space with the lens saying, let's look at opportunities as an investor beyond credit and what that would look like. Really, the only investments we've done have ended up being one in the digital ROSCA space and the other more in the insurance enabler or insurance infra space, really. I think the challenges we've seen on the savings front or the savings and investment front end up being that at the high level, there's two sort of product drivers. You're either enabling this for a safety net, or you're looking at this more from being able to offer returns. And I think and the whole safety net really coming down to enabling this aspect of being able to put some money away type of thing. And the challenges really end up being, how do you incentivize something like that? How do you link it to behavior? How do you ensure that there are nudges? And I sense that from a business model standpoint, and particularly with sort of low income and middle income customers, you're seeing a fair bit evolve on the sachet side of things, but not as much yet around, say, goal based or models that are linked to behavior and outcomes, which sort of make it measurable, or how do you do nudges towards direct savings and those sort of things. So I think that's sort of one challenge that we found. I think the second ends up being that when you step a level below banks and SFBs but move into the fintech realm, it still doesn't seem like we've got a viable commercial model in place to enable this in a big way. It's really hard to construct a standalone business, construct a standalone business model just for savings and savings and insurance, savings and investment. Unlike say with credit or with insurance, and you've seen a proliferation of the latter two, but really not as much on the savings and investment front. I mean, another example really being the whole payments bank piece really not taking off in a way that one would have thought it would, or at least when the regulatory framework was put together for that, right? Even the Indian Postal Bank, which has sort of gone ahead and said that they would do it, you've not really seen much come out of that. So I think that's leading to this situation where you have to necessarily then bundle offerings. So you're offering micro insurance. Can you offer savings alongside with that, or and that could then lend to sort of a level of financial sustainability in this entire situation. I think, like all of us are saying, COVID has really brought this to the forefront, particularly around savings and insurance. The fact that we've seen in our own portfolio multiple examples of the end customer, be it a gig worker or a factory worker, or even a low income, so the house help or other types of workers. There's what you're seeing is a crying need that's coming out, which is saying we really wished we had saved more. And although the data, like Mona pointed out, you're seeing that it's increasing, and there I think interesting innovations that we're seeing coming out, and this is still very early, but perhaps would lend itself better for the business model challenges that I just talked about, is around employer match programs, for example, right? Where if you're a platform for gig workers, and you're working with as a lender, I'm working with a platform for gig workers and I'm providing loans, could I actually enable a savings and investment product? And if I'm doing that, more often than not, you'll find that the employer is actually willing, or the platform where this worker is willing to do a match, simply because that's a huge retention tool or a retention mechanism of the worker for that platform. And we're actually seeing this. One of our portfolio companies, which is sort of predominantly lending, but also offers insurance and savings for the gig worker. They work with one of India's larger food delivery platforms, and they really have, where the platforms actually come back to them and said, look, the savings product that you offered was great. Can we actually ramp this up significantly, and we'll double the match that we were doing earlier, because one, we know that our workers need it, but more importantly, it helps us from a retention standpoint. So I think those are perhaps areas where you could see this approach lending itself a little, enabling a little more sustainable and sustainability into the model. But otherwise, on its own, have we seen a pitch for a pure play savings and investment product or service focused on low income? Not yet, although we wish we would, because I mean, at some level, you also want to be. There's enough on the credit side, perhaps, although demand will far exceed the supply. But I think there's a lot more that could be done on that front. I think with Roscas and the experience we've had has been that it's a proven model, but completely offline. So it's still fairly early days in terms of being able to bring that online and be able to offer sort of an end-to-end digital offering. And I think that space continues to remain large, and there's a large opportunity with that sort of sector. But from a traditional small savings, not yet seeing enough. But some of these are, I think, early indicators of the direction that we could be headed. And I think I'm hopeful that we'll see something.
Sure. Thanks, Krishna. I think a few interesting points that you mentioned, especially around the employer match programs. We surely do hope that this seems more like a permanent trend. Anyways, I would feel this would be difficult to roll back once you have set something like this in motion. But that should work for the benefit of all. One question, Sri Krishna, in terms of monetization, we understand monetization in this space has always been difficult. Uh, uh, and is there any insight around, I mean, at what point does the consumer, is the consumer willing to really pay up or loosen his purse strings, right? You mentioned one, there is a safety net aspect. Second, there is a returns aspect. Probably it's the latter bucket where monetization would still become easier and possible. Any insights on that?
Yeah, so you're right. It is when you cross over into the investment, into the returns realm that I sense that the consumer is willing to pay for it. I think it's also going to come down to where in the life cycle is the consumer. I think for for entry level workers, a lot of times this is more about just the safety net because they are not yet thinking in terms of goal based saving. Because you're still, you're just gotten, you're 18 or something, you've just gotten your first job. Let's assume for a minute it's a delivery boy or some of those jobs which are perhaps easier to access for a youngster today. You're mostly focused on consumption. How do I make sure I'm getting that first mobile phone or perhaps that first two-wheeler, maybe a round of gifts, etc. But once that satisfaction, that gratification is coming, I think is when the aspect of saving for a goal starts to kick in. And I think that if there is the returns element, but there's also enough nudges and you're being motivated to save for the goal, perhaps then if there's an instrument that enables that, I may be willing to pay a small amount of money for something like that, even though at some level that's not yet in the returns realm, it's still more in the safety net. But I think that from what we've seen with some of the other products and services, if you're providing a quality service and even at the sachet type of form, with volumes you'll be able to make a reasonable amount of money even, and I think consumer willingness to pay for it with small amounts, I sense is going to be there, Amol.
Got it. Thanks, Sri Krishna, for this. Let's move on to the third segment, which is neobanks or challenger banks, whatever we want to call them. And let me bring in Tom here. Tom, you have seen neobanks across other geographies. We see a much more evolved segment in the US, in Europe. Very early days in India. What do you think could be drivers for these kind of business models in a country like India?
Thank you, Amol. It's really great to be on the panel and with the audience today. Appreciate it. To set the stage on a couple points. In terms of the way that we are looking at neobanks, and Priyanka's presentation at the beginning referred to it as digital-only financial services. So I think that can be interpreted by different people in different ways, but that's a good definition. Everybody, I think, agrees that neobanks lack physical branches. What I would like to just highlight, and maybe it could be discussed later, is that we tend to think there's still an element of touch for the population that we seek to positively impact through our investments. So this combination of tech and touch is something that I think can still fit within neobanks. At Oiko Credit, we're working to build on the experience of investing in a lot of traditional financial institutions, both in India and outside India, and then leverage that into some more recent investments in tech-enabled financial services businesses, to assess where this space is headed. So what we've seen, in our view, in India and many countries, is that there's been this wave of disruption in financial services that was initially led by digital payment services, and quickly, and in some cases before, but combined digital lending. So now we see this wave that is led by neobanks. And basically, the aim is to redefine the customer-centric banking experience. And so I think that this is really exciting. And as you said, Amol, it's something that we've seen happen quickly and powerfully in Europe and the US, and it's moving globally. So to answer the question about what we see as drivers of neobanks, I would definitely say consumer behavior, and it just the data is telling us that what matters more, especially to younger consumers who are adopting digital financial services very quickly, is just simply the speed and the ease of being able to use that service. They don't seem to care as much about a historical brand name of an institution or other services that they may someday, far out in the future, think they might need. But it's more about what does this do for me now? And definitely whether there's a branch or not doesn't seem to matter very much. We think in India, we think it's really telling also that these companies have been able to establish trust with clients more quickly than I think a lot of skeptics expected in a pretty short period of time. So it seems like it's about how simple it is and whether it provides what the client needs. So given this backdrop of strong apparent and demonstrated demand, and we're following this every day, is this ability to grow or be limited somewhat by access to smartphones and internet. So that is a driver that I acknowledge is key. Another one is in terms of the use of cash and the degree to which cash is still used is going to hinder that growth. If a person is getting paid through their business or as an employee in cash, then it's just much more complicated to put it on a digital platform. So to the degree that there is less cash used, and the degree to which this evolves in India specifically, that will be a promoter of rapid opportunities and growth for neobanks. I'd like to mention probably the last one is regulation. So I think the audience can better parlay our experiences in some other markets, but just to mention an example, we invest in there are several large developing economies with that are leaders in fintech. It's clearly Brazil, Kenya, India, Mexico, among them. And so we invest in a company in Mexico called Kubo, which is considered by most as a neobank. Because of they were a first mover, they obtained regulatory approval and are somewhat protected for what appears to be maybe another year or so. So you've had large Brazilian and Argentine neobanks coming into the market, but they haven't been able to play in the same way, in the same sandboxes with Kubo, because they've had to partner with other banks that do have licenses. So this is actually slowing the growth. And I won't pretend that I know the regulatory system in India, but that's just some kind of a context to be thinking about how that will evolve in India and how the regulator is operating. Tied to what the regulation can do is to help facilitate data points. And the more data points available in an environment in a country, then the more quickly neobanks and other digital service providers can capture that data in data lakes and then use it to offer services sustainably, successfully, and have the impact in our case with our investments to direct where those services are going effectively. So since I think India has the potential to generate massive data points even in different segments and different geographies, I think that's something to watch also in terms of drivers. I'll leave it there, Amol, and thank you.
Sure. Thanks, Tom. I think the last couple of points that you mentioned were pretty interesting. The regulatory aspect, I mean, that's always a fine walk, right? I mean, there's a wire card kind of a scenario that you want to avoid, but you also want to be as supportive to newer business models. I mean, I don't know how to think about this, but so far, I mean, there's kind of a fine balance between letting business models innovate and having some kind of oversight to ensure that nothing happens no problems happen at a scaled up level. So it will be interesting to see how this plays out in India. Let me bring in Shashank here, and Shashank, specifically, I want your inputs on one of the points that Tom mentioned, which was uh, the combination of touch and tech for neo-banking models, or for that matter, many business models in India. But India is also a different market, right? Where many a times tech becomes a barrier because many segments of the society cannot access tech in the manner others can. What's your view specifically when it comes to Indian market? What will it take to convert the mass to these new age models of neo banking, or for that matter, even other products digitally?
Thanks so much, Amol, and it's a pleasure to be a part of a panel like this. While I try and answer that question, I just want to share a couple of points to set the context or background. So for one, Rohan, there are 6 investors. So that tells you who's at the, who's really in the center of this solar system, sort of thing, right? It takes 6 of us to be able to stand up to him on the point that he wants to make. Secondly, I'll let you and all the participants who are listening in know that because of my absolute lack of charisma, Amol told me that, I am the ideal party pooper to be in a conversation like this. So I will try and play that role as well as I can. So I just want to talk about a couple of challenges, and I really liked Tom. He sort of partly took my thunder away as well about what I wanted to say. So I think one is, I just want to think about, are we ambitious enough as a group here, right? So when we talk about financial inclusion, are we sort of buying the story, being a party pooper? Are we buying the story that we sell, right? Because I think if you were to look at financial inclusion, the total number of people that you can put in a large room is lesser than the number of people that attend a large wedding in New Delhi, right? And then there's 1.3 billion of us out there, right? So I think that context seems to be sometimes amiss, right? And because we sort of, of course, we go and speak about all of this, and that's partly because of how complex this entire space is, right? And I think as you go into some of those, I think I will just take the blame from the investor side a little bit, that we tend to get much closer to the market than to the consumer when we look for solutions, right? We inadvertently, and sometimes with our checkbooks, guide entrepreneurs, right, towards solutions that are much more closer to market than closer to the consumers. If I was to put this very harshly, this then leads to solutions in search of problems, right? We figure out, and I won't go because we've had lots of them, but we've got a solution. Now let's look at a problem, because in India, everything that you say and the opposite is entirely true, and there's data for it as well. So I think these are some of the challenges that I worry about, and I think we need many, many more banks. We need institutions that will deliver financial inclusion to everyone, and that's not happening. Because if I did not know what a neobank was, or let's say that if my grandma was still alive and here, how would I be able to show her that this bank is different from that bank? I really struggle. I think it would be difficult. And of course, maybe I don't know enough about banking, but I'm just saying. So this is what sort of really, worries me, because most banks, financial institutions tend to start looking at each other. The other point I think is when we talk about fintech, right, it seems to be so much about the tech and less about the fin, right? And I think that's a very, very important point, because you're not going to get fin till you don't get super distribution in place, right? So what's happened is we've already got, thinking about the tech being in place. We've got manufacturers who can manufacture. But as they manufacture, they manufacture for much, much closer to market, right? Very marginal incremental changes taking place. And then, of course, we make it difficult for people like Rohan to be able to go out and push in a market that is so difficult to distribute it, right? So it's wonderful to talk about, how telecom is reaching everybody and whatever. But forget about last 2 years when you've talked about cost of data, right? What about cost of data before that? If you look from a 5 or 7 year standpoint, what's going to happen 2 years out? Right? Can you build a business that sits on this cost of data? Right? Maybe you can, maybe you can't. Rohan can answer. I certainly can. Right? So I think that's just sort of one part as you start thinking about when you're closer and closer to the market and less. If you talk about consumers, right? And I can say, I'll give you a simple example. The liquidity required for insurance in the crisis of a lifetime. There is no individual alive on this planet who has seen a crisis like this. Right? Just imagine 6 months ago, we had no insight into how this will play out. Not one institution, as far as I know, went to somebody like Rohan and said, okay, let's go cream this. Okay, we'll put liquidity on the table, you go distribute insurance and we'll sell down. We don't have a market for it, I agree. We didn't even attempt, right? I'm so glad that Krishna mentioned about the employer participation program or things like that, right? And I think that's because we want to continue to stay closer and closer, just a little bit from the market than what our consumers need. If you see everything that we talked about, Priyanka put it out so nicely, and of course CII, I think, is, at the forefront of having all of this. Where is privacy protection? Where is protection for consumers? Yeah, we have a consumer protection fund and all of that. So where are we on that, right? And who bears the cost? Consumers are bearing costs for whom? For ecosystem development. And then these are not wealthy customers because you wouldn't dare do it to them. Like, they'll come after you. So somebody who ran into trouble in a fixed income mutual fund has now got consumers going after that, even though they signed up for it, right? So you won't be able, but our customer set, so to say, is having to pay a price for something like that. And then when we're talking about education, look at our literacy levels. How many of us are designing for that literacy level? Right? When you look at apps or you're looking for whatever, we are invested in a firm in Bangladesh. And I can tell you, they've built such a beautiful business by building both the physical distribution and the digital distribution. And I was, it's a little disappointing for me that in a country, and we're supposed to talk about India, but I'll just tell you about Bangladesh, right? 2 out of 3 people still don't have a savings bank account. But everybody that we talk to is so fascinated about what's new on the app. You don't need that. First fix this, and there's a lot of jam to be had there in many ways. But as you can see, I've obviously got very carried away, so I will stop so that others have a chance to, and then maybe come back here. Thank you.
Sure, Shashank. No, thanks for grounding us back, and we will definitely have more questions for you as we go along on this. But the 2 points that you mentioned, those are very relevant. Privacy, of course. We are, again, like all things, there's a bill. We'll have to see how that addresses concerns for all constituents across the industry. So let's move on to, we discussed 3 segments, right? We discussed insurance, we discussed savings, we discussed neobanks or challenger banks. Let's move a bit towards how impact is driven these segments as well as others. And let me bring in Mahesh here. So Mahesh, the pandemic has really put the financial vulnerability of all segments of the society right front and center, right? And various people have jumped in to resolve this. Private public initiatives that promote financial inclusion, security, and so on. Right? You are pretty close to the ground. Which groups, which sections of the society have these programs been targeted to? What are the key programs there? Are they really benefiting the intended recipients and helping them become more financially resolute?
Yeah, thanks a lot, Amol. Thanks to everyone, and thanks, Shashank, for shaking it up. And I was wondering who else can be a black sheep like I was trying to do. He has taken the thing from me. But a little bit on this, I think I just want to take 2 things here, a little bit of data macro, and I echo a lot of what Sri Krishna said and also Rohan. But before that, Mona, I wanted to pick on the fact on savings and all, and this is where I'll probably bring a little bit of, I could call parallel data rather than saying contradictory, if that is okay. So the thing is that we lost 20 trillion rupees in the last quarter in terms of GDP. Out of that, 50% is government loss because of the program and they don't, government programs and they can't have the tax revenue. 21% is lost by firms. Out of that, the most are actually small and medium and micro enterprises and self-employed. Only 25% income is lost by individuals. Again, we all know that incomes are lost at the lowest levels, not at the highest levels. And if you flip it, it also talks about savings. So that's where I come to. In terms of, that is one part. Now, of course, there are some early shoots of recovery. There is data now that manufacturing activity is gone up. And however, employment, you see, unemployment rate has come to 7%. But what is worrying is labor force participation has gone down to the all-time low in September to 40%. So what does all this reveal is that a huge segment which is still getting back to shape, which is gig workers, informal workers, people, and 80% of India's workforce is actually informal and the most vulnerable. And if you take that statistics into it and how they were impacted the most. And in terms of years to the ground, I really want to honestly admit, for the work we do, we don't go out so much. And this is one of the biggest hit of the pandemic for me personally. When you say year to the ground, I wish I could say honestly, I had my year, I didn't have. The only things I did is through the companies and the work we have done. And one of the phenomenal work was done by Dalberg, which is a publicly available report, which actually shared very important statistics of people who are affected. And also some of the things which you specifically asked about. More than 55% of the people, they of course targeted lower income people. 55% of people by June had lost their jobs on all the livelihood, 50%. And this is a large survey. This is not a small survey done in the 20,000s, not in some thousands, a significant sample size. And more importantly, second, which was also data to look at for this discussion is how many of them had drawn 60% of them had drawn all their, whatever savings were left. And more than 50% had borrowed money already. This is as of June. So I would like to kind of somewhere correlate this with the macro rate of savings. And I'm not surprised savings has gone up. If you think about service economy, by and large, other than say accountants, law firms, and people like artists, most of the service economy is higher rich people getting service from, if I could call it, poor people. That's how the service economy works. Whether it is watchmen, whether it is workers, whether it is various people, delivery boy, which are all affected. What is happening then? They are saving because consumption was a hit. They could save, but the people down are not saving. There is no money there. I think we just need to have that kind of a clarity in terms of people affected here. Then I go to the one company which we invested in, which was actually a company called Flagship, which brings government programs to people who need these programs. And linking that with the Dalberg survey, what are the schemes which worked in this period? Number one, very effective use of PDS. PDS just went up. In the same survey shows that the PDS and the ration reach people. Best scheme which has worked is actually. Number two, after that is actually Jandan. In a lot of places, Jandan has worked pretty well in this period, which is very encouraging to this conversation. So what I went around to look for is what is the work Flagship is doing, because they are all the time looking at which is the most affected group and what are the services and benefits that they need. And very revealing, started clocking 50,000 plus people they reach every month now in terms of the needs. And this should gladden Rohan, is that most affected are, of course, gig workers, reinforces the same thing, informal workers, the most affected. And what are the top three things they're asking for? This is where I got up, actually. Now, these are, of course, ration, not surprising. They're looking for ways to get ration. Despite all the digital stack we are talking about, India is one of those countries where we normally need two documents. We not need two documents to get anything done, and you need the first document for the second one, and the second one for the first one. So this is how we work. So it's so hard to get things going. So just an Aadhaar or something doesn't make things work. So they always need other accounts. So first is ration. Second is what is called typically in the old days as labor card. It's a construction card. That's the second biggest thing in demand. Third is insurance, health insurance in that. Very, very surprised to see. Very, very high demand for people asking for insurance. How to get registered, including, of course, the government scheme, Ayushman. There is a phenomenal demand for it. And the fourth one is people genuinely seeking for savings account opening and asking for that. These are the services which account for 70% of his requests coming month on month. We are tracking that. So it's been a phenomenal eye opener for me. So I'm just saying that on the one hand, they are the most affected, and definitely they are not sitting on a positive savings rate. and the growth of savings for by no stretch of imagination. And that corroborates to what Sri Krishna was saying, that it needs schemes like matching and others to make this give a fill up. Otherwise, it's not like that. They are drawn from their savings, but they are looking for insurance. They are looking for savings account. And the question is, how is the liquidity going to come? And that's kind of one of the most crucial things where there is a real think about demand stimulus being talked about already by the government. Some of that is super needed now. And I've not touched the small and medium enterprise because most of that gets into lending part, but they are the other one segment super impacted. Small and micro enterprises, absolutely, and I think 33% of them are have not yet opened, still not open. And even a country like US, where I'm comparing the data is very current. End of September, 25% of small medium enterprises are still not open. So it's no surprise that in India, 33% is not open. So you can imagine, and they are the ones who provide the most jobs. So the knock-on effect of that. But their needs are mostly about lending, by and large, because they have exhausted their savings. So, but since this is beyond lending and not about lending, so I'll stay away from that. But that's another big gap, obviously. Unless that flows through, the liquidity won't flow through to the bottom.
Got it. Thanks.
Amol, if I may respond and clarify just one point on that. No, I just, very helpful insights and your experience, Mahesh. I just want to clarify that, first of all, I agree with all that you have shared. And the rate of growth of savings or the flow of money into banks, which is, all actual data that I shared, I do not correlate that with health of either nano, micro, small, medium enterprises or health of businesses of any category at all. That's liquidity and that's profit. I mean, two different things. And also, there is, as you rightly said, there has been a blip. So there was a period of lockdown which saw certain amount of flows in, and there was a period of unlock which saw outflow. And we just have to sort of make sense of this. Clearly, there is less investments going into businesses from whichever quarters of money is coming in. They're investing less into businesses. And this was a trend that we saw even pre-March. So you can look at the December data and September data. So yeah.
No, thanks for that. I know that the overall savings rate is always a catchy, difficult thing to do. It's a broad measure. I totally appreciate it. I was just bringing the level below that. I just want to share that the rebound is definitely positively impacting larger companies. I talked about small. Large companies are on the way to rebound. Also, they have access most of the credit also. That's the parallel to keep in mind.
No, sure. And I think what you said resonates completely about people wanting more savings accounts. I think this is the experience we're seeing in the small finance banks. If small finance banks were worried about dormant accounts earlier, it is now not that they're worried about inflows, but I think on an overall balance sheet basis, they're looking at much more idle funds and inflow of funds which may have either been sort of invested in businesses and in circulation rather than sitting in bank accounts. So, the flip sides to money in the account as well. And certainly, I think the usage of bank accounts is now not so much of a problem for those who are already connected digitally, etc. I mean, there's, of course, a vast majority that's still not connected, even within their customer base.
Thanks, Mona, for this. As we move towards the end of our discussion, let me again try to put some positive spin and move towards where do we see green shoots of growth. So let me bring in Aditya here. Would be useful to know, Aditya, where are you seeing tailwinds that would promote greater access and penetration of financial services, lending or otherwise? We do understand, given the current pandemic and the situation, probably credit would become the first need for people to come back, and then they could move on to other products beyond credit as well. So which are the sectors, which are the segments where you see tailwinds?
Sure. Thanks, Amol. I think, in terms of tailwinds, I think we see that two ends of the spectrum, right? So one, you have extremely digitalized businesses who are doing really well because their business was not disrupted by this whole COVID thing, and they don't have the physical contact, so their business goes on. On the other, you have these extremely insulated let's say, rural or rural businesses which have little or no contact with the outside world and are sort of self-contained, and they have again remained resilient. So I think we've seen is that, these are the two broad spectrums at which, have things have performed well. And I think in the last few years, as the other panelists indicated, we've all been focused on the SME, right? So the local kirana store has been, giving all kinds of, you're creating an app for him for accounting and this and that and lending and all that. So that he has been the focus of, in general, the ecosystem. While, say, someone like an agriculture or rural has not been as key, because, to be honest, there is the sector has its own shocks and stuff like that. So that sector has been excluded, or I wouldn't say excluded, but the emphasis has definitely been more on the SMEs than on these kind of rural agri businesses. And that's where we have seen a fair amount of resilience. Of course, I think the digital space has already been spoken about, and other panelists have touched upon that. So, keeping the digital aside, and we're also seeing, like, say a sector like agriculture is something that we see as a key opportunity. And this need not be just in terms of financing. Of course, financing or credit will play a very key role in it. But that also has, let's say, ancillary impacts like aggregation and also payments, right? So currently you are not able to efficiently offer payments or efficiently aggregate because of a lack of a payment solution. So yeah, you have to solve these problems together. And also, again, like Shri Krishna was also mentioning, so standalone non-credit businesses are very hard to crack. You've seen even the large payment banks, many of them return their licenses because even with the middle class, payments isn't a viable business. So I think we see at least at this point, rural and agri is key or interesting areas where there has been resilience. And I think it also is sort of for investors and for companies a reflection that yes, you will have your growth in terms of the urban and growing businesses, but you also need to balance it out just from a portfolio management perspective to have some of these resilience bread and butter businesses like agriculture, which will not be exciting and then not sound cool, but are extremely resilient in such times.
Sure. Thanks, Aditya. And there are a couple of things you hinted here, and specifically in agri. We do realize the importance of this sector, both in terms of GDP contribution, more so in terms of the number of people that it employs, and consequently has a bearing on general financial well-being. You mentioned, other than credit, you mentioned other services, you mentioned aggregation, you mentioned payments. So what are we talking about here? There's a need to build like an Alibaba kind of a ecosystem focused on agri, which would like do everything right from helping inputs, helping to source inputs, to channel credit, to produce, to whatever you want to help you find buyers, and do that at a scale and in a tech-enabled manner. And do you really see such kind of models emerging in India?
To be honest, I think there are attempts being made. I think it's too early to say that there are models that have been created. I think there are attempts being made. That said, credit is still the hook. So nobody will come to you, or we don't see people lining up to say, okay, you're offering me an agri platform for buying my fertilizer and then for also selling my produce. So let me sign up on your app. So you don't have, not too many farmers recently we have seen the evolution of FPOs, the farmer producer organizations, not too many of them will be enthusiastic about that. So credit is still the hook that sort of brings people onto your platform. And then we have some cases and some investing companies who are therefore making use of let's say, the people on their platform who have come primarily for credit to channel other services like what you just mentioned. I think, for example, the recent farm bill should also help in accelerating some of these players to sort of aggregate and formalize. It's still credit driven. You can't. It's still very challenging to build a standalone model for
I think we lost Aditya.
So Amol, if I may add,
Yes.
particularly when we are talking about agri per se, definitely I think it's an important point that we're discussing here, and definitely one of the views that at least I have for this space is in agri you need to have market linkage, whether you are talking about credit to this segment. Standalone credit models would be difficult to build because see, I think fundamentally the problem is that you can't have a EMI kind of product in agri because a farmer sows in say X month, and then he sort of harvests his produce 4 or 5 months later on, and then sort of sells it in the market. And the challenge is you can't have an EMI kind of option with him. You need to have a bullet payment sort of method that you will have to deploy for sort of recovering the loan that you give. Plus, if you have to do that, you have to make sure that you're right there at the time when the farmer sells his produce. Because if you're not there, then the farmer would have his other sort of expenses that he or she has to meet. And therefore, that market linkage becomes the key. And if you have to do that, of course, the payment becomes the key, right? So you'll have to look at a end-to-end solution. If you talk about an Alibaba kind of mechanism in agri, and I think market linkage is the key. Without that, at least I feel it's going to be difficult to sort of build a large-scale sort of credit business in agri.
Got it. Thanks, Saras. Aditya, we did catch a large part of what you said. If there's nothing, is there anything more that you want to add, or we could move on to?
No, I think I think Saras sort of continued from where I left off, so that's pretty much what I would have said otherwise in any case. So that's good.
Sorry to barge in, Aditya. Sorry about that, but yeah, I thought it was relevant.
No, I think we all have the issue, so I'm glad you were able to continue.
Okay, so let's move on to the last question, frankly, that I have for all of you guys on the last topic. I would love to go across the table here and have each one of you pick up one or two segments or sectors other than credit that you think will have the potential in India for the next 3 to 5 years. Whether be it due to COVID or things coming back to normal, but there are structural trends in place. If you were to choose a couple of segments, which would that be? I know I have investors largely, but Rohan, you are also welcome, and I would love to actually have your views as well. But let's start with Sri Krishna. Your couple of segments and reasons why you think they will do well.
I think on the I sense that we could start to see more opportunities on the micro investment type of an approach, where you anyway started to see some of that happen with middle income consumers, for example, where people have also moved away from, let's say, traditional approaches of savings bank or fixed deposit, moving more into mutual funds, not so much into direct equities, but at least mutual funds, and you're starting to see that pick up. So could there be a model that evolves where you're able to do that in a way where you're further sort of making it micro, but enabling it in a way? Of course, it requires this. We've always we're sort of looking at intermediaries who are closer to the customer at this point in time, and then they would necessarily need to be able to. And there's regulatory challenges around. You can't hold it for too long. You have to obviously have someone on the back end that you pass it on to fairly quickly. But I'm seeing that there is an offtake for something like that around even things like SIPs, etc. Particularly because it's also linked to when you're linking it to a worker and income flows. So I sense that and of course you've got all the digital rails and all that in place. There's nothing new that I'm saying there. But I sense that with micro investments, you could perhaps be seeing more taking place in the next 2 to 3 years as sort of a savings mechanism, effectively. So that I think is one. Not sure if there's really, unless there's something dramatic that comes through. Not so sure if we'll necessarily see something with just with pure micro savings are the one and a business model around there. Although that would be a great outcome for the kind of customers that we care about the most. But I don't necessarily see that happening too soon. I think that role will largely, I sense, get played by the banks and more importantly, the small finance banks.
Got it. So micro investments for Sri Krishna. Mona, your pick.
Well, I feel, again, this is sort of a perspective of players at the bottom of the pyramid, where I feel the approach to towards the microcredit or the MSC or the micro and small customer would probably tend towards, from the bank side, from the small bank side, tend towards micro banking, sort of trying to provide a more holistic set of services, something that all banks have failed at for the middle income segments, or people in the middle and the upper middle income, where services tend to be delivered by specialized players in a disaggregated manner, and nobody really goes to one bank for everything. But I'm hopeful that through the advent of small finance banks that is focused on mass market, the microcredit, which is the mainstay today, will evolve into micro banking. Some banks are already doing it, have made a start, and I'm hopeful that this will progress. This will be for the benefit of customers, because things that we're talking about here, whether it's micro insurance, micro investments, the whole host of services are best delivered by banks if they partner with the right sort of combination of fintechs and neobanks, etc. So as a trend, I'm actually more hopeful than sure, but I see a lot of value in that from the customer's point of view.
Got it. Thanks, Mona. Shashank, given whatever problems we know exist, despite that, couple of sectors or segments you think could do well in the near future?
I thought Amol, will bring me in right at the end and say, "Oh, Shashank, I'm sorry, we are out of time," or whatever. But I'm glad. So first of all, I'll do a both put and call on this, right? So what I'm bearish on is I don't think that we are going to solve for consumers, right? We're not going to solve for persons with disabilities. We're not going to solve for uneducated. We're not going to solve for customer sets. So that's a little disappointing for me, at least over the next 3 to 5 years. I don't think that's happening. But I think, and I'll steal Sri Krishna's idea and paraphrase it a little bit that Mona said. And then, of course, what Saras and Aditya, and finally Rohan. So I think some elements of saving and insurance, because we'll see defensiveness, right? So we are going to stay defensive for a while as a society, whether we like it or not. So I think these two will start picking up. The other, I think, is that you're going to see a cash flow aligned thing. And I think this is where my bullishness is on solving for problems, right? So what will happen is that when there are market linkages in place, and I see agri is going to be one very, very clearly, and therefore maybe you will see FPO getting far more access to credit than they have in the past. But I think it will, so the kind of customers that we want to go for will benefit because the larger businesses will get interested in that. And that's the problem that a lot of people, I think, will solve for. And therefore, our customers will get served.
Got it. Thanks, Shashank. I was going to ask you the question first and not leave you out. So don't worry on that. Tom, what segments do you think will do well?
Well, yeah, it's. I guess I think about my colleague Anirudh Sarda, who's telling me, reminding me about there are 190 million people in India, unbanked or underbanked, and so I think it forces me to think, longer term, big picture, and how will things evolve even post COVID, and hopefully post a economic impact that won't last too long, even though it's incredibly painful. So I think that we will see some of the dynamics related to savings that Mahesh and Mona discussed. So I'm going to pick a model that captures savings, creates data as a neobank, and then leverages into other sectors so that they can gain scale. And eventually that will involve lending. where the margins are typically better. And just kind of wrapping that up, I think the backdrop is also there because you have super talented entrepreneurs who are interested in addressing these problems with solutions, and you have commercial interests, and you have, say, impact investors who are there's just a growing group of people who are going to support the right models and the right entrepreneurs going forward. So that's my response, Amol.
Thanks. Saras?
Yeah, so I think for me, I feel infra plays, and particularly I think the view is that the asset owners or incumbents that we largely talk about, whether it's banks or the insurance companies, while we say that they would get disrupted, I definitely feel that they bring some value. They have their own share of strengths that they bring, and what they definitely lack is finding newer means of distribution. We talk about sachetization, so therefore finding sort of creation of new products and finding ways and means to distribute those sort of newer sort of products, right? And I definitely feel there is a play for the players or startups who create infrastructure to facilitate sort of creation of these products and distribution of these products through alternative mechanism. And definitely I feel that infra plays that could play along across different sort of line of products, whether we talk about credit or insurance or savings. And I definitely feel that's gonna sort of be one of the key areas for me in the next 4 to 5 years.
Got it. Thanks. Mahesh? Yeah, so I'm wary of giving prediction. We have an entrepreneur. I think entrepreneurs find opportunities better than investors always. So we will always be behind on that. So wouldn't like to claim any trend, anything like that. But I think, again, coming from a hope, I think there's a parallel thing of labor law reforms. I see something from there. There's a move towards fixed term contracts. There's a lot of noise around that could be a risk or something. But I actually think fixed term contracts is a phenomenal way by which many of the informal workers can actually get to a level of formality without actually becoming the main employees. I think that is where I see models are likely to come, perhaps, because then they will be looking for, of course, the mainstream providers and big ones for the larger companies. But there are enough MSMEs in India who will probably opt for fixed term contracts, which will open up opportunities for probably like a lot of things which we talked about linked to savings and others, and combining with the kind of thoughts that Sri Krishna had. I think those are places where it will go. And but when I say it will go, I mean it will totally depend on entrepreneurs who will create those opportunities, and we'll see. And sure. Aditya?
Yeah, I think I've already made my pick in agricultural mode, and if I claim to be a long-term investor, I shouldn't be changing bets in 15 minutes, I think. So, I mean, yeah, I'll stick with that. And the only thing I'd say, I mean, hopefully, I think, a little bit of, let's say, with this work from home and de-urbanization, let's say, I mean, rural purchasing power also increases and sort of creates more opportunities in that segment going forward. This is something I would add, yeah.
Got it. Last but not the least, Rohan.
Yeah, I was going to steal Shashank's line and saying you were probably going to put me out because the investors have sort of ganged up together. So look, I think everyone sort of covered most of the points. Our sense, being in the space that we are in, is that I think anything that's also liquidity is going to be paramount, right? Now, if you don't have liquidity, then all of these are sort of hearsays about what can one possibly do in terms of whether that's payments, micro savings, micro investments, micro insurance, so on and so forth, right? So some of that wheel needs to be back into motion. And what is required to bring that wheel back into motion, whether that's infra, whether there are sort of new labor laws that are coming into place, will be what defines sort of the next 2 to 5 years, really, from my business trying to go out there and create micro insurance products. It's extremely important that he actually has that 500 rupees that covers him for a malaria or dengue insurance. If he doesn't, then irrespective of the infra route that I take or how contextualized that I make my product, it's not going to work. So for us, I think sort of that anything that has a huge part to play in improving the liquidity of that end consumer bottom up is going to be the defining factor for sectors.
Got it. Thank you so much. I think in terms of our discussion, we have covered quite a bit. I would like to take the last 5 minutes to put some Q&As which have come from the audience and which have been shared with us. So there are 4 questions. Let me put those out there. I would not want to cold call and make it a university class, but might suggest a few names who might tackle those questions. So the first question is on credit, is on lending. Is it possible to lend with outcome-based repayment terms? Typically, existing players are not in a position to do that, right? Whether NBFCs or MFIs. Is it possible to have such kind of models? And I would probably call upon Aditya, even Priyanka, Tom, Oiko has huge experience across credit models. Any of you want to take this question?
I'll just say it's a super interesting question. At the level of the institutions that we invest in, providing an outcome-based loan, if I understand the question, I haven't seen it. I've only seen it, a step or two up the chain to drive outcomes in social impact in prisons and educational systems. But it causes me to research and look more into that. Thanks for the question.
Sure, Mahesh, please go ahead.
I don't know whether I will answer this, but we have experimented with an impact bond, which is in the workforce area, where we have actually linked to the jobs created by a pool of 5 workforce skill development organizations. And the way we have structured it is in 18 to 24 months, if they generate so many jobs, which is outcomes, then the interest is subvented via outcome funders. So the impact bond is not grant to grant. So it's not a typical impact bond structure, which is grant oriented, but the interest rate is actually subvented, and we have given the initial FLDG for it. So that way, what we have done is that once the companies achieve impact, if we get the outcome funder, then the outcome funder takes care of the interest element to a large extent, which is a big incentive for them to achieve the outcome, impact outcomes. Only focus on impact outcomes. Of course, there will be repaying, which is anyway going. So this we have done with a set of 5 skill development companies as a.
Got it. Thanks. Yes, Shashank, please.
So, I can say from my fixed income days that this is a very classical non-recourse structure that whoever was talking about, right? So if you do non-recourse, it's because you say, listen, I'm not so worried about the obligor, but I'm going to be able to get my cash flows out. So it has to be cash flow aligned and based, right? And I think people have tried to then spread that risk by putting credit insurance in place, which is super complicated. And I don't think it's for this client set at all, but it could perhaps, I think, work in places like agri. So where you've got a very nice counterparty and then, you strip reasonable amounts of risk along the way in the transaction, right? So you fund the farmer and you strip away some risk by either from a storage capacity standpoint or whatever else the risks are. Maybe that's the only place that I can think of.
Got it. Next question, probably Shashank, you would be one of the candidates to pick this up. How do you really address the challenge of poor financial literacy in low-income customers? Given, these are the people who are hit the most, right? Be it frauds, be it some kind of schemes or phishing and so on, right? So what can be done really to address this challenge of poor financial literacy?
So I think, this is a very classical social way of, sociology way of looking at things, right? So whom are you placing the blame on? On the victim, right? So what I'm saying is that the moment you start recognizing that it's not my fault because I'm, financially not so literate as the rest of them are, then I think you'll start seeing solutions to all of this stuff emerging, right? If I had an automatic insurance to getting my payment back in 3 hours, if I said that this was not something that I authorized, trust me, every bank in the grandmom will put a mechanism in place if they had to pay for it. All of this will start to get solved. As long as I'm the poor guy who's taking a hit on my balance sheet. So this is not going to be solved by doing more financial literacy, this, that, or whatever, right? This is about the application and execution of law that's already in place, or putting right sort of mechanisms in place, right? So I think the question itself is always put in the wrong way, right? This is somebody who's vulnerable, who's getting cheated, and now we're going to say, listen, you have to pay, or it is your lack of security that cost you this. It doesn't work like that at all. I think it's the wrong way of looking at things.
Interesting. It just gets even more important. I mean, this is obviously not keeping pace with the level of tech and digitization which is happening on the product and services side, right?
No, I can go back and return I can go back and return a packet of butter and whatever else because, or whatever, right? Look at what happened to Cadbury's, because God knows there was a worm or not, but they had to hire Amitabh Bachchan to bring trust back, right? So there are proven models. This is an incentive problem. It's not a problem about the consumer side that we are after.
Got it. Someone else has something?
Yeah, I just want to add, like, for example, in case of microfinance, we saw this excuse in terms of orientedness early on. And then there is a robust credit information bureau, or fairly robust credit information bureau, which provides MFH, which provides data and puts the onus on the lender to check before lending to a client who could be vulnerable. So I think we need to have these kind of systemic solutions that will come, and not just an open literacy kind of thing is hard to achieve.
Got it. So I've got more questions coming in, but I think we are almost out of time. So what I'm going to do is I'm going to email these questions to the panel and give it back to the IIC in terms of responses. Would that work, Ananjana?
Sure, Ramon.
Okay, I think let's just to bring this to a close. I think we had a fantastic discussion over the past hour or so, and we touched upon quite a few interesting themes, right? Insurance, where we are saying the problem of awareness seems to have been solved by the pandemic. Now it's more of contextualization. Savings, we are seeing increase in savings given the situation, but still difficult to build standalone models in this space. We talked about neobanks. We talked about how consumer behavior, along with regulations, could be key drivers here. Finally, we talked about what all things need to change in terms of getting to impact financial inclusion, how privacy is important across all these business models. Lastly, we talked about sectors which are seeing tailwinds, basically fully digital models of businesses or insulated businesses from the current environment seem to be doing well. So it was great to have your views. Thank you, gentlemen and ladies, for your inputs. I will hand it over to Ranjana.
Thanks, Amol. Thanks. This was a very exciting discussion, actually. And I go back really enriched in the insights and perspectives of the whole of the panel. And thank you so much, all the panelists. I think the key messages we carry is that, of course, I think post-COVID, probably credit will come to the rescue of the lower segments at the first go. But I think there are many non-credit interesting models which we have a lot of hope on. So thank you very much, everybody, for this lovely session. And for the audience now, we are now releasing our second report on state of impact investing in India. And for that, all of you can tune in for Audi 1. My colleague Swasti will take over from here. So thank you very much, everybody. And yeah, over to you, Swasti.
Thank you. Thanks. Bye.
Thank you.
Right.